Have you ever sold a stock only to watch it double a few years later? Or bought a stock because everyone seemed excited about it, only to see it fall shortly after? If so, you're not alone. Most investing mistakes don't happen because investors pick terrible companies. They happen because investors react emotionally to information that doesn't actually matter. Every day, we're flooded with headlines, analyst opinions, market predictions, economic forecasts, social media posts, and endless financial commentary. The problem isn't that there's too little information. The problem is that there's too much, and most of it is noise. Over the years, I found that one of the biggest advantages an investor can have is the ability to separate signal from noise. In today's video, I'm going to share the simple 3-question filter I use before buying, selling, or making any major portfolio decision. This framework has helped me avoid emotional mistakes, stay focused on what actually matters, and become a much more disciplined investor. And the best part, it's incredibly simple. So let's get started. I think one of the biggest investing mistakes people make is confusing activity with progress. We feel like good investors should always be doing something, checking our portfolios, watching financial news, reading analyst reports, making trades, reacting to headlines. But investing isn't a game where the most active participant wins. In fact, some of the best investors in history have succeeded largely because they ignored most of what everyone else is paying attention to. Think about it. If you owned a private business, would you sell it because somebody offered you 15% less than yesterday? Of course not. You would focus on the business itself. Is my revenue growing? Are my profits increasing? Are my customers happy? Is the company becoming more valuable? But somehow, when stocks are involved, many investors forget that they're buying ownership in businesses. Instead, they become obsessed with price movements. And that's where the trouble starts. Before I get into the filter itself, let's define what we're trying to accomplish. Signal is information that impacts the long-term value of a business. Noise is information that attracts attention but doesn't meaningfully affect long-term outcomes. Signal includes things like revenue growth, earnings growth, free cash flow growth, dividend growth, market share gains, strong capital allocation, and durable competitive advantages. While noise includes things like daily stock price movements, most analyst price targets, most economic forecasts, most political headlines, social media opinions, and financial television predictions. The challenge is that noise feels important. Signal usually feels boring. But boring is often where the money is made. The first question I ask whenever I encounter new information: will this matter in 5 years? Most headlines fail this test immediately. Let's say a company misses their earnings estimate by 2 cents. Financial media treats it like breaking news. The stock falls 7% and investors panic. But ask yourself, will I care about this specific earnings miss 5 years from now? Probably not. Now, compare that to something like a major competitive advantage disappearing, or a company taking on excessive debt, or management consistently making poor capital allocation decisions. Those things absolutely matter 5 years from now. The 5-year test instantly removes a huge amount of noise from your decision-making process. So, whenever I see a dramatic headline, I try to imagine myself sitting here in 2031. Will this event still matter? If the answer is no, it's probably not worth making a portfolio decision over it today. Let's use a real-world example. Imagine the market falls 20%. News headlines become extremely negative. Experts predict more declines. Social media becomes filled with fear. Now, ask yourself the first question. Will this market decline matter in 5 years? Historically, the answer has usually been no. What matters is whether the businesses you own continue generating cash flow, growing earnings, and increasing dividends. The market's mood today often has very little relationship with the value of great businesses 5 years from now. Question 2, and this is probably the most important question in the entire framework, because stocks are not pieces of paper, they're ownership stakes in businesses. Whenever new information appears, I ask, does this change the business? Notice what I didn't ask. I didn't ask, will the stock price go up tomorrow? I didn't ask, what does Wall Street think? I didn't ask, what are other investors doing? I asked, does this change the business? Let's say a stock I own falls 15%. Many investors immediately assume something is wrong. But a falling stock price doesn't necessarily mean a falling business. The stock price and the business are not always moving together. Sometimes they are, but sometimes they aren't. The question is whether revenue, earnings, cash flow, competitive position, and future growth prospects have changed. If those things remain intact, the stock price movement may simply be noise. Imagine you own Costco, not the stock, the entire business. Would you care if somebody valued it at a lower price this week? Not really. You would care about membership growth, store traffic, profitability, expansion opportunities, customer loyalty. Those are business metrics. Those are signals. Everything else is secondary. This mindset shift alone can dramatically improve investment decisions. And question number 3, does this change my original thesis? Before I buy a stock, I try to answer one simple question. Why do I own this? Not why it's popular, not why analysts like it, not why it's trending. Why do I own it? Maybe it's because the company has a wide moat, strong dividend growth, consistent earnings growth, a high return on capital, excellent management team, or a reasonable valuation. Whatever the reason is, I write it down mentally. And when new information appears, I ask, does this invalidate my original thesis? If the answer is no, then I probably shouldn't be doing anything. Many investors sell stocks for reasons completely unrelated to why they bought them, and that's often a mistake. Let's use SCHD as an example, because many viewers own it. Imagine SCHD underperforms the S&P 500 for 2 years. Some investors start questioning their strategy. Others begin chasing whatever fund has recently performed best. Now let's apply the filter. Question 1. Will this relative underperformance matter in 5 years? Maybe not. Question 2. Has SCHD's underlying strategy changed? No. And question 3. Has your original reason for owning SCHD changed? If you bought SCHD for dividend growth, quality companies, and long-term wealth building, then temporary underperformance doesn't invalidate that thesis. The thesis remains intact. Therefore, no action is needed. Simple, but not always easy. Human psychology works against us. We evolved to react to threats. When markets fall, our brains interpret that as danger. When markets rise rapidly, our brains interpret that as an opportunity. The problem is that investing rewards behavior that often feels uncomfortable. Buying when others are fearful, holding during uncertainty, ignoring exciting stories, remaining patient. The market constantly encourages action, but wealth is often built through disciplined inaction. I like to think about investing like fishing. Imagine you're standing on a lake. You know the biggest fish are out there, but they don't bite every minute. You have to wait. You have to be patient. You have to ignore the temptation to constantly move locations or switch strategies. Many investors do the opposite. Every time a new stock gets attention, they cast somewhere else. Every new headline causes them to move again. Every market correction changes their plan. Eventually, they spend all of their time moving and very little time actually fishing. Great investors identify quality opportunities and then allow time to work in their favor. One of the biggest benefits of this framework is reducing unnecessary decisions. Every decision creates the possibility of making a mistake. When I was younger, I felt like I needed an opinion on everything. Every earnings report, every economic release, every market prediction. Now, I spend much less time asking, what will happen next week? And much more time asking, what will matter 5 years from now? That simple shift has improved both my investment results and my peace of mind. Think about your investing information the same way you think about nutrition. Not all information is healthy. Some information is junk food. It tastes good, it's exciting, it's entertaining, but it doesn't improve your investing. Other information is nutritious. Annual reports, cash flow statements, dividend histories, valuation analysis, business quality metrics. Those things aren't always exciting, but they're far more valuable. The best investors consume far less information than most people think. They're just selective about what they pay attention to. The next time you see a scary headline, a market crash prediction, a dramatic analyst downgrade, or a stock making huge moves, stop for a moment and ask yourself 3 questions. Will this matter in 5 years? Does this change the business? Does this change my original investment thesis? If the answer to all 3 questions is no, there's a good chance you found noise instead of signal. And the ability to ignore noise may be one of the most valuable investing skills you can develop. Because successful investing isn't about knowing everything. It's about knowing what matters, and more importantly, knowing what doesn't. If you enjoyed this video, make sure to hit the like button and subscribe. And if you'd like to read the article this video is based on, along with other investing articles, you can find them on the Yieldr app Learn section. There's a link in the description below. Thank you for watching, and I'll see you next time.